Hey, welcome to this video on which DeFi or decentralized stablecoins are best. This has been just an incredible week, or an incredible year in decentralized finance. We're seeing several new innovations, several new experiments. Within the last 2 days, we saw an algorithmic, fractionally backed stablecoin go to zero, and we saw a billionaire investor, Mark Cuban, actually get burned by it. And it's getting a lot of attention. It's getting some bad publicity. People are worried, like, oh, I knew that everything in crypto was unsafe. It can just go to zero. And one of my motivations of this video is to just try to share some of the lessons that I've learned, actually reviewing the technical details, reviewing the security audits, reviewing the white papers of several different projects in the DeFi stablecoin space. I've seen elsewhere online there are other videos that just look at stablecoins kind of in general from a year ago, looking at like bank-backed stablecoins and a few of the DeFi ones. But now that there are several new innovations in decentralized finance, algorithmic stablecoins, the timing seems very good to just have a discussion, help the community, help everybody in the space think about what is important, what kind of stablecoins do you want to see succeed, what kind of stablecoins do you want to hold when there's many different options. If you could get any stablecoin you wanted and they all cost the same to you, are there some stablecoins that you'd actually prefer over others? We'll find that the answer to this is certainly yes. And I think many people don't know this, so let's actually just dive in and start to explore why that's the case. So a few ways that we'll cover this. What are some of the key differences? What are different use cases for different stablecoins? And when you exit into your next stablecoin, what would your top choices potentially be? So a few quick disclaimers. Everything here changes quickly. A lot of the projects that we'll cover, some of the most interesting ones, have only existed for the last 2 months. So we are looking at some of the cutting edge in the space right now, and things change quickly. I respect all of the projects that we'll talk about, and I've spoken with a few of the creators just to understand their projects further. And I do have some concerns of some of the projects that we'll look at, so we'll go over those concerns. Lastly, everything here is intended as educational content. Nothing here is financial advice. This is just trying to help you get the knowledge that you need to make better decisions for yourself. A few of the stablecoin evaluation criteria that I'm looking at, some of these you've seen before in other places. Some I have not seen anywhere else, and I'm hoping to bring a new angle, something helpful here, specifically like this last one on the list, design favors. Who does a stablecoin intrinsically favor? Does it favor people who adopt it early? Does it favor people who are holding on to some kind of collateral that is trying to back that stablecoin? Is the stablecoin actually designed in such a way that it favors you as the person who is holding it? There are very big differences in some of these designs, and if you're not aware of these differences, you stand to potentially suffer the consequences of that. Or reap the rewards of coins that are really favoring you as the holder. So as I've been speaking, I don't want to talk through all the text on this slide. Some of you have probably read it, but just wanted to share because this review will inherently have some subjectivity to it. I will be sharing my opinions and my personal view. At the same time, I'm going to try to keep it as objective as possible using these criteria that I think would be important to or probably should be important to anybody who is really well informed on the options. Just a couple more that I will speak to because they are most critical, in my opinion. Value retention. If there's a bank run, if you like a famous economist gets on the news and says, I really don't trust the theory behind this project, and then everybody panics and tries to escape that stablecoin, how confident are you that you can get your money back out? Could Mark Cuban get his money back out in this 2 days ago? No, he could not. So value retention in my mind, this is among the highest thing. If you don't actually have a stable value, you really have nothing. I mean, it's kind of multiply your value by zero in that way. And yeah, so I mean, we'll get into some of these as we get in. Let's go to this next slide here. So these are some of the coins that we'll be looking at here by type, like LUSD. This is one that is only a couple months old. I think it's among the most attractive and interesting. It is crypto backed. It's backed only by Ethereum. And as long as Ethereum holds any value above, say, 20 cents, then your value is quite safe in LUSD. We'll look at that a little bit more in detail in the future. I'm seeing this should say liquidity here. All right. We have DAI. We have, just as a comparison, USDC, USDT. These are the fiat-backed options that a lot of folks probably know about. And down here we have a few more decentralized finance-based projects, Fei, Frax, Iron. And who do these favor? Fei. It appears, as best I understand it, it favors early adopters and kind of potentially disfavors stablecoin holders long term. I'll share my reasoning for that. You can see if you agree. Things like Frax and Iron. Iron is the one that actually Mark Cuban was holding that has gone to zero in the last 24 hours. And it's just an idea that you can back $1 of value with less than $1 in guaranteed value. This is one of the projects where I actually spoke with the founder of Frax to understand that further. And as you read the white paper, as you learn about some of the design decisions there, it does sound like in theory it could work, but it certainly has its risks, and we'll explore that a little bit more later as well. One of the other major things to look at here, under circulating supply, things like DAI, one of the largest, earliest, most established decentralized finance stablecoins, has a very significant circulating supply, 5.2 billion. I mean, at least in relative terms within the DeFi ecosystem, $380 million of 24-hour volume. So it's fairly liquid. If you compare that to things like LUSD that have just under 1 million of 24-hour trading volume, there are definite differences there in terms of what that means for your ability to trade it efficiently. If you wanted to buy $1 million worth of LUSD yesterday, you probably couldn't have done that with pure efficiency. But this is, as these projects evolve and mature, we're likely to see that change over time. Next slide. Looking at each of these projects, value retention, decentralization, smart contract complexity, capital efficiency, and value accrual. So I'm not going to walk through every single rating here. A few of these projects will actually get their own slide, and we'll dive into some of these. But a few highlights just while we're here. With LUSD, which I think is such an innovative project that is worth highlighting a little bit, the value retention, this is on a scale out of 5. So how can something have a value of 4.9 to 5.1 value retention? It's fascinating. We will look at that a little bit more closely in a few slides, but just put a pin in that and remember, this is a very interesting option to hold as a stablecoin. The decentralization, I'm giving it a perfect 5 because as long as Ethereum continues to operate, LUSD will continue to function. It is just a pure smart contract based stablecoin, and it's only backed by Ethereum. So in contrast to DAI, which also has a very high value retention and is also highly decentralized, DAI is now additionally backing by some USDC. So you're bringing in some of that fiat-backed, bank-backed currency that introduces a little bit of centralization risk. But overall, DAI is still a fantastic option. When we look at things like capital efficiency, so the 110% CR for LUSD, that is collateralization ratio. How much collateral does somebody need to provide up front in order to mint LUSD? If you have $1,100 of Ethereum, you can mint $1,000 of LUSD. In contrast with DAI, if you had 100 or 1,500 in Ethereum or collateral that you're putting in, you could get 1,000 of DAI back out. So how efficiently can it safely be created, or at least at the minimum ratio? There's a big difference there. With LUSD, when people are creating it, there's a one-time fee of 0.5%, and those fees are actually potentially paid back to you. They are paid to people who hold the LQTY or liquidity token, and you receive that token for free just by parking your LUSD in what they call their stability pool for a while. So the fees and the revenue that are generated there, actually you are eligible to receive some of the upside if you're just parking in LUSD long term. Additionally, from the minting perspective, LUSD has a 0% interest loan. So if you have $100,000 of Ethereum and you want to buy a car with it today, but you don't want to sell any of your Ethereum, you can take out a 0% interest loan of $30,000. You pay a one-time 0.5% origination fee, or whether it's buying a car, a medical bill, what have you. It's just fascinating to see this kind of capital efficiency available, approved in seconds by a smart contract. Additionally, LUSD has some really innovative close proximity to what I call value accrual options. So by holding LUSD long term, you have two main benefits that are exclusive to LUSD. The first is by parking your LUSD in their stability pool, you gain free LQTY, the liquidity token, which it's a non-governance token. The only thing that LQTY does is receive automatic dividend payouts for loan origination fees and redemption fees as people convert LUSD back to Ether. So you get the LQTY token, which is a revenue generating asset. Additionally, in the stability pool, you have upside to liquidation premiums. This is getting a little bit out of scope for this presentation, which is trying to give a high-level overview, but just in short, by putting LUSD into their stability pool, if somebody who created LUSD, in this example we're talking about here, you didn't create the LUSD yourself, you just bought some LUSD off the market somewhere. You thought LUSD is a nice option, I want to hold it. If you bought it, you hold it, you don't have any risk of getting liquidated yourself, you're an owner of that LUSD, you put it into their stability pool. If somebody else gets liquidated, you actually receive ETH. You receive the Ether for part of that collateral that was liquidated, and you receive it with a 10% premium paid to you. So it's almost like automatically buying the dip of LUSD with 10% premium to you. So these are some interesting things that are unique to LUSD in terms of additional value accrual options that you have. In contrast, just comparing it side by side with DAI, and by the way, I should mention, I do not work for any of these projects. I have no affiliation. I'm not paid by any of these projects, so these are all just my opinions here. I think LUSD is a DAI. I have a ton of respect for it as the first project in this space that has just been a trailblazer and paved the way. But in the same way that you see Ethereum as a second generation finding many improvements over Bitcoin, in my view, LUSD is kind of a second generation, which is finding many improvements in capital efficiency, value accrual, etc. So with DAI, you have a little bit less capital efficiency, and you also need to pay a stability fee as long as you have minted some of that DAI. You need to pay an ongoing fee. So it's a pretty significant difference. And we'll go in a little bit more detail on that later. USDC, it's a little bit boring. I'm going to kind of assume that, I mean, you probably know it is just backed 1-to-1 by US dollars in a bank account somewhere. The decentralization is very low. USDT, maybe this is, I don't know how controversial this is. I'm giving USDT a value retention of 3 because in their first transparency report, like they got audited by the New York Attorney General where they were confirmed as lying. The New York Attorney General said they lied. They kind of came in defense and said they spun it in a positive way, saying, oh, they didn't discover anything fundamentally wrong. Well, they did discover that you were lying. And in their first transparency report, USDT is backed something like 65% by corporate paper. And everyone's asking, what is that? How secure actually is that? So I'll provide some references to that at the end and in the description of the video, but let's move on for now. If we then look at Fei, this is a very innovative, purely decentralized finance stablecoin. In terms of its capital efficiency, value accrual, in my mind, there's a lot of question marks here, and the value retention of 2.5. If anybody loves the Fei project, like I'm not trying to offend anybody here. I'll share my detailed reasons for that rating in 1 or 2 slides. Frax is a project that we'll also look at in a couple slides, but just to share the numbers while we're here, my subjective opinion of its value retention, how confident I am that I hold Frax and I'll be able to redeem it for a full $1 of value. My confidence is a 2 out of 5, and I'll share the reasons for that. Iron, which is just a fork of Frax, they cloned the open source of Frax, and they did adjust a few parameters. They kind of removed some of the safety rails that Frax had. Iron is the one that went to 0. Mark Cuban got burned by it. So there are differences, Frax and Iron, but they're also, I mean, it's a fork of a project, and fundamentally they're both fractional in the sense that they try to peg a dollar valued stablecoin using potentially less than $1 in hard value, with a highly volatile asset being one of those backed values. So let's move into the next slide. Like, let's look a little bit closer at Iron and Titan. So Iron and Frax, we looked at those. These are the fractional reserve currencies from the previous slide. They're both under collateralized, and as the collateral, so Titan being the collateral for Iron, FXS being the collateral for Frax, you can see the price chart on the left showed that Titan actually went to 0, and when it did, the Iron token, the Iron stablecoin, lost its peg, and anyone who was involved in that project took a haircut. Like you lost some wealth just by touching it. And what fascinates me about that failure is this was not even necessarily sparked by an intentional bank run. There was not even necessarily panic in the market. There was a flaw in the algorithm where the Iron token temporarily lost its peg. It was temporarily at 90% or 90 cents instead of $1. And being at 90 cents, that created an arbitrage opportunity where you had whales buying tons of Iron at 90 cents. And then when they are redeeming that back, new Titan is being minted on the fly. Essentially, the amount of Titan that could exist could get minted approaching infinity, and as that happens, the value of each Titan goes down. So people are buying Iron at 90 cents, they're redeeming it for Titan, they're selling the Titan immediately on the market. That created a downward spiral that just tanked the price of Titan and caused Iron to lose its peg. There was not even necessarily a bank run that started it. So if you then compare that to Frax and say, well, Frax does have a much more thoughtful approach, much more like intentionality behind being safe, taking it slow and steady, not just not that Iron and Titan was necessarily a pump and dump or an intentional scam. It looks like Iron and Titan may have just been more of a reckless experiment that burned people. I think Frax is genuinely, their heart is in the right place, but it is admittedly experimental. So I would like to see it succeed. I think it is a very cool experiment. But would I personally, would Frax be my top choice of a stable coin that I want to hold if I have options like DAI or LUSD? I think Frax, in my mind, it always has that risk of a bank run. And when you think about the bank run, the question should not be if it will happen, but when. If you ask about a bank run and the objection is, why would people ever do a bank run? That's not the question to ask. Like, you don't want to have to worry in the back of your mind of like, what if somebody eventually believes this thing backed by less than $1 might not be redeemable reliably for $1? You kind of get it. So just another quick slide at this, looking at the value of FXS. We've also seen this is a highly volatile token there, so it's not at zero yet. It's, I think, around $2, and I do hope that it remains stable. It would be cool to see it succeed, but I mean, fact is, it is a volatile backed token. Looking at Fei next, so Fei is that stable coin that if we just kind of zoom back out to this slide, Fei, who does the design favor? It favors early adopters. This is what I claimed on this slide, and I gave Fei a value retention rating of 2.5. So why did I give these ratings? Like, what's wrong with me here? So here's what's interesting about Fei. First, you can see its price history there. So you want a dollar-pegged stablecoin to have a reliable value of $1. You can see that right from Fei's launch, it was down to around 69 cents, far below its peg. It had a very bumpy road, and a lot of people were very unhappy. And if you look at their model for retaining a dollar peg, you can see they call direct incentives on the right. If the value of a Fei is below $1, if it's at 98 cents, this is their example on the right, people who mint new Fei are rewarded with a 2% bonus on receiving a little bit extra. So if you're an early adopter who's minting this, essentially anybody who helped mint Fei, the early adopters, pushing its price closer to $1, they're getting rewarded. What if Fei is at 98 cents and you lose faith in it for whatever reason, you're bank running it with everybody else? If Fei is at 98 cents and you try to redeem it for the underlying value, you pay a penalty of 4%. So the question in my mind, all other things being equal, is this a caveat that you want with your stablecoin? How will Fei handle a bank run if it ever happens? In my mind, somebody who did not mint Fei, but who just eventually, this 3-4 years out, you just bought some Fei out on the open market, and you thought, okay, what is just another stable coin? Sure, I'll hold it. And in the back of my mind, it's like Fei is kind of holding a gun to your head, which is saying you better not try to redeem this in the future. If you do, if it ever loses its peg, if anyone panics for whatever reason, like, we are going to burn you hard, and we're going to burn you harder the harder that it's below $1. So is it a cool, innovative project? Is it a cool, innovative idea? Yes. Do I respect it? Yes. If all other things are being equal, is Fei the stable coin that is designed to reward you as the holder of it? In my opinion, no. It looks like it's more designed to reward the early adopters who were receiving all those rewards in that earlier phase. And yeah, like after it reaches equilibrium, it only has that downside risk, in my opinion. Let's look at DAI. So DAI, first generation decentralized stablecoin backed by the MakerDAO. It historically struggled a little bit to hold a tight peg to $1. You can see its price history there. And in recent times, it's become much more successful holding that tight peg. One of the ways that it achieved this recent success with a very tight peg is they decided to adopt a multi-collateral approach. So DAI, I think today it's collateralized by approximately 30% of USDC, which just helps to tighten the peg. And on the right, so DAI is currently experimenting with accepting real-world real estate as collateral. I think I heard it's around $200 million of residential real estate that they are facilitating the flipping of somewhere in the United States. I love the idea of that. It's such a cool, innovative idea. At the same time, when I just put my objective third-party hat on this, looking at this from the outside, I have spent years evaluating various real estate investments, and people make mistakes in that. Am I confident that a DAO will never mistakenly overvalue a piece of real estate as collateral? That, in my mind, is something that, while I encourage it and celebrate it and love to see it happening as an innovation, in my mind, that is a risk that, maybe initially they're super conservative, but as time goes on, we saw all the issues with real estate and subprime mortgages of the 2008 crisis. How do we know that 10 years out, as greed and financial incentives continue to take hold, do you have absolute confidence that we will never mistakenly overvalue any real estate? That's kind of an interesting question there. So nothing but respect for DAI, but it is kind of experimental in my opinion of holding that dollar peg. And despite that, I still gave DAI a value retention of 5 out of 5. I think at this time it's quite stable, but longer term it'll be interesting to see what happens there. So value retention of LUSD. This is one of the, in my opinion, kind of a hot new stablecoin that's only been in existence for maybe a couple months or so. You can see its price history there on the left. One thing that's interesting about LUSD, that red line that I added is on the dollar mark. And you can actually see that LUSD, the intrinsic value of it, is above $1 just slightly. So it looks like it holds a value of around 2 cents or 2 cents above the dollar peg. And now this is where we kind of need to get into that value retention score that I gave it of the 4.9 to 5.1. Where does the 4.9 come from, and where does the 5.1 come from? The 4.9 comes from the fact that there's a risk if you buy into LUSD and you're just kind of trading, you're not really super optimizing everything. What if you bought LUSD and it was near $1.03, and then a couple days later you sold it, and at that time it was closer to $1.01? So that's actually you're losing around 2% there, $1.03 down to $1.01, losing a little bit less than 2%, and that's potentially an undesirable trait, that there's a little bit of price volatility just slightly above $1. How does it get, so that's why I deducted 1/10 of a point down to 4.9. But if you can buy LUSD at $1, if all prices are equal on a site like Curve, then getting LUSD for just $1, in my view, you're actually gaining value because its intrinsic value is likely above that. And the reason for that is how I give it the 5.1 rating, which this is a stable coin that I would have absolute confidence in holding its value, which I'll get to in a moment. Not only does it have that high confidence in redeemability, but LUSD uniquely has those value accrual options that we talked about before. The LQTY cash flow generating token that you receive for free just by staking it. This is not a 2017 ICO where you're buying some SEC security. This is one of the more recent innovations in DeFi where just by being a user of the platform, by being a user, you are rewarded for free with some LQTY tokens. If you want to say it's not quite free, the only risk you're taking is is there some smart contract risk in the code? But LUSD overall has the smart contract complexity of low, which is a little bit outside of scope for this, but they've had several audits. Their audits had among the most comprehensive unit testing, among the highest code quality of different projects. Getting a little bit out of scope here, but it's something to look into. Do your own research, learn more about it. So why does LUSD have, in my opinion, such a high confidence of being able to be redeemed for around $1 or around $1 in value? So a thought experiment in my mind that I ask myself, what if the price of Ether, which is the only collateral backing LUSD, what if Ether drops by 99.9% or more? It goes from today around 2,300 or so, it drops all the way to just 20 cents per Ether. Personally, I don't see that happening, but even in that extreme of a situation, one LUSD can still be redeemed for around $1 of ETH. You would in that case receive 5 ETH, which you could then sell on the market at that time for $1. So if you are in decentralized finance, if you have faith that Ethereum will continue to exist in some form, probably above 20 cents, and that somebody would probably be willing to buy that 20 cents ETH from you, even in that super extreme scenario, then holding LUSD is a relatively safe bet. There's a low degree of smart contract risk because it's a simple and elegant approach overall. And while I've been talking, maybe your eyes might have gravitated to that visual on the right, which is discussing how LUSD holds its peg. So the arbitrage strategy, if the price ever exceeds $1.10, then there's an arbitrage strategy where you can take out a loan with 110% collateral ratio and then instantly sell. And when they say take out a loan, they're meaning mint new LUSD, and then you sell it on the market for that value, which is above $1.10. When you do that, you're pushing down the price back into that soft peg range, that blue range on the visual. Similarly, if the LUSD price is ever below $1, which we see there was a very brief period in its first month or so where it looked like it was below $1, in that case, you can buy that LUSD. In that case, I think the low looks like it was around 90 cents. You could buy LUSD for 90 cents, immediately redeem it for $1 worth of Ether, and then sell that Ether on the market. So it compared to some of the other projects, this is a relatively simple option to just hold that price. So I think long term, it's likely to have, LUSD is likely to have a value closer to $1.01 or something that's above $1 because of these intrinsic benefits that it has, particularly attractive during markets with downward price volatility, because this is again getting a little bit out of scope, but LUSD stability pool, if there are liquidations from people who minted it, you can receive a 10% premium on Ether from that. So just looking at this next slide, one mental model that I have looking at like the decentralization of these different options and decentralization on the y-axis, confidence of redeemability for $1 on the x-axis. You can kind of see confidence of redeemability, very, very important. In my mind, your options, some good options are USDC, DAI, LUSD. When you look at decentralization, There's a spectrum there. DAI is very high on the list, but because DAI now also inherits some of the centralization of USDC, it's a little bit lower than LUSD, but in my mind, DAI is still an excellent option. And I will use DAI. I do use DAI in many use cases, which let's actually talk now about some of the differences in those use cases. And the other Fei, Frax, Iron, USDT, I mean, you can probably infer why I have these in these positions. Confidence of redeemability, if any of those have a bank run, LUSD is going to come out glowing. I mean, as long as anyone's willing to buy Ether for more than 20 cents, like, you're coming out fine. Same USDC. Things with Fei, that's where you're literally getting punished for trying to redeem it. With Frax, that's where with Frax and Iron, this is where it kind of went to zero recently, and you're potentially struggling, even though they will mint you up to infinity amount of their fractional reserve to try and make you whole. If the market is in this downward spiral that we saw with Iron, and they're minting you 9 billion Titan tokens, and each of those are selling for like close to zero, I mean, it's up to you how confident you are that you can effectively redeem that for $1 worth of value. So let's look at a little bit of advantages by use case. So are you doing short-term trades? You want to minimize slippage and have a very tight peg close to exactly $1. DAI, USDC, both attractive options. I think if they were priced the same, DAI, in my opinion, is a little bit nicer. You're supporting the DeFi ecosystem, improving the liquidity of a truly decentralized option, and DAI just has a wonderful organization behind it, kind of a DAO, decentralized autonomous organization. So it's not like a traditional corporation or company, but DAI just has a wonderful community, excellent option, and USDC as well. If you are more of a longer-term fundamentals investor, you're moving into stablecoins for extended periods, then it becomes increasingly attractive to maybe consider LUSD in that case. With LUSD, if you want to put it into Liquidity's stability pool, you're receiving some LQTY for free, which is that cash flow generating asset. Additionally, by being in the stability pool, you're eligible to automatically buy the dip if Ethereum price drops drastically, and some of the people who created the LUSD that you bought, if they get liquidated, you're receiving their Ether with a 10% liquidation discount. And if you don't want to be buying the dip and maybe you just wanted to stay in a stable coin, it seems like eventually some integrated service will probably offer an auto conversion that takes that Ether with the 10% bonus that you got, immediately converts that back into LUSD, and just puts that back into the stability pool. This does not exist yet, but it's such an obvious idea. It seems like just a matter of time. And I'm not, again, I don't work for LUSD. I just think it's such a cool, innovative project. I feel like I should mention some of the very significant drawbacks to LUSD, at least for now. Because it is a DeFi pure play, it's not available on any centralized exchanges yet. The only way to buy it, as far as I know, is through Curve, the stablecoin automated market maker. You can buy it on Curve, or you can mint it yourself through the Liquidity smart contract. Additionally, a major drawback currently is it takes 2 hops to trade with most non-ETH assets. And most non-stablecoins. What that means is if you're holding LUSD and you want to buy something like, what's some example, like BAT token, Uni, Sushi, something like that, first you're going to need to trade from LUSD into DAI or USDC, something that has a direct trading pair with your desired destination token, and you incur fees and potential slippage in that step, then there's that second hop to your actual destination asset. So I think this is kind of natural in my view to expect these kind of drawbacks for a project that has been in existence for a couple months. But at the same time, while we're mentioning it's a very new project, Liquidity has more than $2 billion of total value locked already. It has already more than 700 million circulating supply, I believe. Let's take a look. Yeah, 700 million circulating supply. It has over 2 billion in Ether collateral backing it. So that's not small time. Like, it's been around 2 months. It's got over 2 billion of some whales who apparently believe in the fundamentals of that project. So that's quite interesting, just to keep in mind the advantages by use case. In some future day, if you're looking to get into a stablecoin, maybe LUSD is a cool one to consider if you're going to hold it for a long time. So some of the takeaways: not all stablecoins are created equal. Let's learn from Mark Cuban's experience and hope that in the future, as more of us in the decentralized finance space learn about the fundamental differences, keep in mind some of the underlying principles of differences in value retention, reliability there, smart contract risk, capital efficiency, and specifically also who was it designed to favor. This is the one that, again, I had not seen it in any other videos so far. Who does the design favor? Does it favor you as the person who just bought that stablecoin on the market? Does it favor an early adopter and then kind of hold a gun to your head if you would want to redeem it in the future for the underlying collateral? Does it favor somebody who's kind of speculating on some under-collateralized or potentially under-collateralized highly volatile asset? Who does it favor? Who was it designed to favor in the smart contract? That's something very interesting to consider. And then based on your use case, is it short-term? Is it long-term? Is it a volatile bear market where you expect Ether price to potentially drop a lot? Maybe in that case, LUSD, you have that additional value accrual from liquidations that you receive. So just sharing a few references and thanks. I have to give a shout out to Bankless. That's where I first heard about the Liquidity project. Shout out to Justin Bram. He has an excellent educational YouTube channel. And his channel is such a gem. It is such a small subscriber count today, relatively speaking, but the quality of his content is just incredible. Coin Bureau has really great resources that helped improve and broaden my understanding of various stablecoins and DAI. And then CoffeeZilla, I think 3 days ago, he had a very in-depth review of the USDT Tether current state of affairs, which if you haven't seen it, I know a lot of people say, oh, USDT is totally safe now. I mean, I recommend checking out CoffeeZilla's USDT review of it. Additionally, some references on the liquidity.org site, MakerDAO, all the links in the description to all these channels I'm giving a shout out to. I hope this video was helpful. I hope that you came away with this thinking that now you're equipped with new principles to keep in mind. What are the valuation criteria that you will use the next time that you're going to get into a stablecoin? How confident are you that you'll be able to redeem that if you need to? And depending on how long you plan on holding it, are there stablecoins that were designed to be user-centric, to be friendly and potentially reward the holder of that stablecoin? Or is it a stablecoin that is really behind the scenes, kind of designed to ultimately favor some other stakeholder who's not necessarily the holder of that stablecoin? So hope this was helpful and have a great day.